On Tuesday, Turkey's central bank opted to cut both ends of its interest rate corridor, amidst rumours of a possible Moodys upgrade. On the phone with me now to discuss Turkey further is SEB's Mats Olausson. Mats, this decision comes as the central bank seeks to prevent the flow of money into its surging stock and bond markets from pushing up the Lira. An effective strategy, do you think?
Well, to the extent that the appreciation pressure on the Lira comes from hot money capital inflows, it is an effective strategy. And indeed, three factors, I think, combine in making this the case currently. First, we have historically low yields in much of the world. We have, on top of that, low volatility and an improvement in risk appetite. Now, adding to that, the fact that the Turkish economy has turned the corner, just looking at the PMIs at the 15-month high and the recovery in credit growth only adds to this. So we had expected the central bank to cut the floor in the interest rate corridor by 100 basis points in the first quarter, but we thought that they would probably not start already at this meeting. Well, they did, and now we look for another 75 basis points. And then towards the effectiveness of strategy, this strategy, you can look back in history, and indeed this is exactly what they did in the autumn of 2010, when they cut the low end of the corridor from 6.5 to 1.5, and in one go in November by a full 400 basis points. That indeed was the start of the Turkish Lira's underperformance, which continued throughout 2012.
Turkey is emerging as a powerful player for 2013, with some even querying if the country could become the China of Europe. But with the rebalancing of Turkey's economy towards exports coming to an end, and analysts arguing that a process relying on a surge in gold exports and weak domestic demand is unhealthy, how achievable do you think the IMF's 4% GDP growth forecast really is?
Well, I think that the IMF's forecast is not only achievable, it will be exceeded in my opinion. But gold exports are not going to be the driver of the economy. I mean, Turkey has a very young population, savings are low compared to other places. The recovery in the global economy is relatively weak, and altogether this means that domestic demand is going to come back to the driver's seat for growth, and we expect GDP to increase by 4.5% this and 5% next year. Unfortunately, this improvement in domestic demand and growth means that disinflation will become harder, and that the reduction in the current account deficit will reverse, and the deficit will increase modestly again. And this obviously is a dilemma for the central bank. They try to reduce the carry on the currency and at the same time prevent excessive credit growth. So this is why they have the strategy of reducing the floor of the interest rate corridor and at the same time tightening macroprudential measures. And we'd expect more of this to come.
Moodys raised speculation this week that a second ratings lift to investment grade is imminent following Fitch's upgrade in November. What could this do to Turkey's economic shape? And similarly, with discussion raised once again this week regarding Turkey's admittance to the EU, what impact will a shift closer to an investment grade sovereign rating have on EU entry?
I think very little. The investment grade is no membership criteria. Apart from the Cyprus issue, there are other things making some EU members block negotiations, even though that might ease up a little bit now. But the investment grade is testimony of progress made over the last decade when it comes to stabilization of the economy, on moving forward on reforms. And this indeed has helped Turkey to be the fastest and become the fastest growing economy in Europe, not at the rates similar to China, but still best in the region. But overall, it's going to take time for this higher growth to reduce the income differences between Turkey and much of the rest of Europe, to the extent that some countries, such as Germany, will become less worried about the challenges of getting a new, very large member, which Turkey, of course, would be. I think the impact of a potential second upgrade to investment grade would be rather seen when it comes to portfolio inflows, since it would make Turkey an investable country given many investors' mandate, and Turkey would probably also be included in more global indices. So that's where we would see the near-term change.
With all of this in consideration, Matt, what are your forecasts for the Turkish lira for 2013?
Well, we're pretty bullish. Overall, we think that the key drivers in FX markets this year are generally going to be conducive for the lira. But as I explained, we also think that the central bank is going to act to limit appreciation, but not to cancel it out altogether. Overall, By the end of this year, we think that the lira will be about 5% stronger against the dollar, which takes us to about 170 or just below at the end of this year.
Mats, thank you for your comments. That's all we've got time for right now, but do click back to Dukascopy TV for more exclusive interviews. Goodbye for now.